Yeah, I think one of the other legs which I talked about before is you've got your cheap debt, and a lot of that is being raised by issuing bonds to very wealthy people who are just putting it on the pile. The cheap debt also allows you to go and build more resources, more factories, which then again dampens inflation because you don't get a supply shock because you've got an oversupply and you've got tepid demand, and so you just sort of wallow in this world. And so I think we run short duration on, let's call it fixed interest credit and what have you, because my concern is that if we do get a spike in interest rates because markets think they should put up rates effectively, then it's nearly unexplainable to the retail client. But I think there is no cushion to the downside, if you like. It's very difficult for rates to run lower.
Well, I'm going to be even more basic. Why would you want to lend to any government around the world today for 10 years at rates anywhere between 0.9% per annum down to 0.3% per annum, 10 years. So for 10 years, you are locked in, you're guaranteed locked in because you know inflation will be somewhere between 0 and 2. You are guaranteed to actually have an outcome less than inflation over those 10 years. And that's the world we inhabited. Now, bonds has a place, but I like what you just said. And that is, if the yield is that fundamentally broken on long-term bonds, where do you go? You either take credit risk or you take interest rate risk. You can go longer and buy 30-year bonds, but then that behaves like an equity. If you're going to buy a 30-year bond that's yielding 1.4, 1.5, that's called the equity market. You know, at least that can, heaven forbid, that might even generate a profit, or an infrastructure asset. But if you go shorter, you can buy a thing called credit, whether it's a bank loan, whether it's corporate debt, whether it's private lending, and that market is growing. And, you know, the other thing in this environment, we are seeing this market grow because banks are doing their bit in this market, extending loans. I mean, you're an ex-banker, they're extending loans, they're sort of forgiving stuff, they're lowering covenants, but they are constricted in how much they can do. And so the private sector comes in, non-bank financial intermediaries, and offer ideas to companies, small business lending, loans, trade finance, the whole thing. And as an investor, that's good because if I can get somewhere between 3% and say 6% for these types of lending portfolios, the alternative is cash at 0 and bonds, 10-year bonds, less than 0 after adjusted for inflation. And that's a nice outcome. You're taking credit risk, but you just have to do your diligence on the manager, the type of loan, and how they put that together.
Yeah, so it's certainly, from my point of view, it's an active play. It's not an index play.
Yep.
I'm a big fan of index. We all know that. But one of the issues we have in index fixed interest or in any asset class is duration has been getting longer, and that's because people like the Office of Financial Management have been issuing 30-year debt, and that's dragging the duration out, and that's where the risk is. So I think credit and corporate debt is an active management tool or an active management activity, as opposed to a black box solution. And I do caution people quite a lot about, you bought this indexed whatever fund. You don't have anything. The debt or the instrument is in an index. You're buying it. The risk is actually getting longer. As you said, you'd be better off buying equity because, God forbid, they might make a profit at some stage in the future, because there's not much future in, a coupon of 1% or less for a decade. So
I like the credit. I like the short duration credit play. I think that's a very sensible play. And actually, I think the retail sector has been a lot smarter in enabling that area than even the institutional sector, because they're a bit slower. They're actually saying, hang on, I'm not getting a yield. I have enough shares. I've got a property portfolio. I need something different. And the market's reacted and supplied that. The one thing about indexing, I'm going to use the word hate, really hate index bonds. because an index bond, in other words, buying a passive bond benchmark, if you have more in debt or you're lower credit quality and you're in the portfolio, you're passively buying it. And I like what you said earlier. You want to be active on this and niche and buying quality credit. So you want to buy these investment managers, you know, whether through your MDA or through your lists or through statewide, and they're saying, what type of managers are they? Do they think like old-fashioned bankers? What's the quality of the loan? At what price am I underwriting? Am I going to get my money back? And can I make a good return on it? And, you know, a better quality lender will accept a lower return. And if it's a really poor quality lender, you probably want to take, you know, you call that special opportunistic credit, where you're getting equity and all these other kickers and covenants where you can take over the assets. But that's really more growth than income, defensive, right? That's a different environment to the stuff we're talking now.
Yeah.